Welcome to my final project presentation. I have chosen to do my project on the Walt Disney Company. The Walt Disney Company is the market leader in the mass media entertainment industry with business segments in the media networks, parks, experiences and products, studio entertainment, and direct-to-consumer and international entertainment. Through acquisition and investment, the company has and is expected to continue to grow in its industry and market segments. We will start by looking at the balance sheet. In terms of assets, the company has total assets of $98,598 million, made up of $52,832 million in stockholders' equity. When we take a look at the income statement, it shows net earnings of $12,598 million with earnings per share of $8.40 and diluted earnings per share of $8.36, with a total weighted average number of common and common equivalent shares outstanding of 1499. The cash flow statement reflects an ending cash balance of $4,155 million at the end of the year. Moving on to the time value of money. So when market prices are not available, we must rely on valuation models to develop a fair value estimate. Fair value can be estimated based on the expected future cash flows related to the asset or liability. These techniques rely on the estimates and timing of future cash flows, probability estimates, and determining the discount rate to apply. Disney must determine the amount that they must contribute every year to meet their obligations for pension funds and post-retirement medical plans. They use the time value of money to make those calculations, and in order to make those calculations, they must make the following key assumptions. So if we take a look at the balance sheet, we can see that pension and post-retirement medical plan liabilities add up to $2,712 million. Some of the key assumptions that Disney has to make are the discount rate used to determine the fiscal year-end benefit obligation, which for 2018 we see it was 4.31%. They also have to take a look at the interest cost component of the net periodic benefit costs, rate of return on plan assets, and the weighted average net rate of compensation increase. Other assumptions include the healthcare cost trend rate and employee demographic factors such as retirement patterns, mortality, turnover, and rate of compensation increase. The discount rate enables us to state the expected future cash flows for benefits as a present value on the measurement date. And a lower discount rate increases the present value of benefit obligations and increases pension expense. If we take a look at the consolidated statement of comprehensive income, we can see that Disney had to make a pension and post-retirement medical plan adjustment of $434 million. This is significantly important because the increased costs in pension and post-retirement medical plans may reduce the profitability of the company. Future cost increases, decline in the fair value of pension and post-retirement medical plan assets may increase future funding requirements as well. So if we take a look at the cash and receivables, using data from the consolidated balance sheet and the statement of cash flows, cash and cash equivalents have actually been increasing over the last year from 2017 to 2018. Cash and cash equivalents consist of cash on hand and marketable securities, and restricted cash consists of cash posted as collateral for certain derivative instruments. We can also take a look at their free cash flow by analyzing the cash provided by operations, capital expenditures, and dividends paid. And we can see that free cash flow has increased over the last 3 years. In terms of receivables, the company uses the allowance method of doubtful accounts. So here we can see that they have recorded allowance for doubtful accounts at $192 million. The allowance is estimated based on analysis trends in receivables, aging, past collection experiences, and current economic trends. They use one composite rate that reflects an estimate of the uncollectible receivable by setting up an aging schedule that helps identify which accounts will require special attention. And this is used as a control device to determine the composition of receivables and to identify delinquent accounts. So moving on to the valuation of inventories. Inventory is primarily includes vacation timeshare units, merchandise, food, materials, and supplies. Carrying amounts of vacation ownership units are recorded at lower of cost or net realizable value, and carrying amounts of merchandise, food, materials, and supplies are generally determined on a moving average cost basis and are recorded at lower of cost or net realizable value. So if we take a look at the assets, we can see that inventories make up 1,392 million of the assets, which is actually a fairly small amount. It's only about 1.4% of the assets. And the moving average cost method essentially means that a new average unit cost is determined after every purchase and that it is used with a perpetual inventory tracking system. There are some disadvantages to using the moving average, which center around its simplicity and subjective flexibility. But it does allow to track the financial position of the company more accurately. Inventories are primarily made up of their consumer products and interactive media segment. And so if we take a look at the revenues over the last 2 years, we can see that they've actually decreased by 13%. The decrease is important because it's actually due to competition with other licensors, retailers, and publishers of characters, brand, and celebrity names, and developers of game software. And operating results are greatly influenced by seasonal consumer purchasing behavior. Additional valuation issues. Inventories, as stated before, are generally determined on a moving average cost basis and are recorded at the lower of cost or net realizable value. The inventory is valued at the lower of cost or net realizable value through the establishment of markdowns and inventory loss adjustments. The markdown adjustment contains uncertainties because the calculation requires management to make assumptions and to apply judgment. So if we look at the inventory analysis, we can determine the inventory turnover rate. And as you can see, it's actually been increasing over the last few years, and it's well above the industry average of 15.9. Moving on to the property, plant, and equipment. Parks, resorts, and other property are also known as property, plant, and equipment. And these summarize attractions, buildings, equipment, and land. These are the long-term assets that are expected to benefit future years. Looking at the balance sheet, we can see that parks, resorts, and other property make up 29,540 million of Disney's assets, which is about 30%. And we can also see that they've invested a significant amount of money into their parks, resorts, and other property, as these capital expenditures reflect investment in facilities, equipment for expanding and upgrading broadcast centers, production facilities, and television stations. Capital expenditures have been increasing due to the increased investment at domestic and international parks and resorts. Interest expense has a lot to do with capital expenditures and the money that's being used to acquire the property, resorts, and parks. And as we can see, they've had an interest expense of $682 million and $774 million net. The increase in the interest expense was due to an increase in the average interest rates, the higher average debt balances, and financing costs related to the current acquisitions. This increased indebtedness could have the effect of, among other things, reducing the flexibility to respond to changing business and economic conditions. We will now take a look at depreciation. Parks, resorts, and other property are carried at historical cost. Depreciation is computed using the straight line method, generally over estimated useful lives. Disney's attractions building and equipment originally cost $55,238 million. However, the company has already recorded $30,764 million worth of depreciation, leaving Disney with $24,474 million in book value. Disney also has recorded projects in progress, which represent new theme park attractions and resort hotels. According to the financial statements, there are 4 broad categories used to estimate the useful life to ensure assets similar in nature are treated the same across all segments. And here we can see that attractions, buildings, and improvements have an estimated useful life of 20 to 40 years. Furniture, fixtures, and equipment of 3 to 25 years. Land improvements, 20 to 40 years. And leasehold improvements have a useful life of the lease or asset life if less. Looking at the income statement, we can see that the depreciation expense for the different segments is as followed. For media networks, it was $264 million. Parks and resorts had the highest expense at $2,152 million, while the studio entertainment, $55 million, consumer products and interactive media, $9 million. Depreciation expense is the cost allocated to each year of the asset's life, and accumulated depreciation is the total amount of depreciation expense since the asset's date of purchase. Disneyland could have used other methods of depreciation, such as the double declining balance. This is an accelerated method of depreciation, which recognizes a greater amount of depreciation in earlier years and a smaller amount in later years. It would result in a greater change of depreciation and amortization expense year after year. There would be some additional tax advantages, but since there's more expense recorded, then it would result in lower earnings in the earlier periods. So I believe that Disneyland is doing a great job by using the straight line depreciation method. Now, finally, we take a look at the intangibles. Disney has a rich portfolio of intangibles, such as the various cartoon characters, classic films, television programs, and goodwill. Disney amortizes its life intangible assets, such as copyrights on its movies and licenses related to its brand products, and they generally amortize on a straight line basis over periods of up to 40 years. The cost to periodically renew intangible assets are expensed as incurred, and Disney does not amortize indefinite life intangible assets such as the Disney trade name, internet domain, and goodwill. We can see that intangible assets net is $6,812 million, while goodwill actually makes up the majority of it at $31,269 million. The company compares the fair value of each reporting unit to its carrying amount, and to the extent the carrying amount exceeds its fair value, an impairment of goodwill is recognized. As illustrated below, we can see that restructuring and impairment charges were $33 million for 2018. This information is important because future write-downs can destroy shareholder future value, and excessive goodwill can create risks during a market crash and can lead to long-term underperformance. So this concludes my final project presentation, and thank you.